Thanks for tuning into the Portfolio Manager. I'm your host, Neeraj Shah, and our guest today is Mehul Bhatt, founder and CEO of OysterRock Capital. And the purpose of this show is to try and get into the minds of the portfolio manager, to try and understand how she or he is trying to think of the portfolio construct in order to generate alpha over the course of the next 12 to 24 to 36 months. Mehul, great having you on the show. Thanks for joining in.
Thanks for having me.
Now, Mehul, the markets have had a good run, and therefore portfolios of all sizes and all types have had a really good rally.
Sure.
Do you anticipate the next 12 to 24 months to be different than what the last 12 have been?
So we are not big fans of forecasting, Neeraj, but just to put things in context, some of the changes that are happening in India, if we can contextualize into the portfolio, it will help you and the viewers a little better. So there are a few things at work here. One is that, the tier 2, 3, 4 towns are actually now exploding and doing really well. The second wave, of course, also is, this whole, India being included in the bond indices and, the credit rating agencies. US with its debt has a rating which, asks us many questions. But India's ratings also eventually will improve. And one of the important things is the cost of capital converging with US in the long term and with even some of the Asian peers. And that actually puts, a very different angle to this whole story also, which, we underestimate. Add to that the fact that, SIPs are India's 401ks now. So if you're a 30-year-old guy, your parents have influenced you to save all your life, and you're putting money there. So it may not be as flaky or as dicey as a lot of us, who have been doing this for a long time may think. And in addition to that, you meet a lot of young guys. They're incredibly smart. So many more pairs of eyes are looking at Indian markets now, and companies specifically, that the inefficiencies have become far fewer. And like you see a bad quarterly result, the action is immediate. You see a good quarterly result, the outcome is immediate. So I think put all this together, markets, are not necessarily cheap right now. And, the small is more expensive than the mid, and the mid is more expensive than the large. And, these things, so basically what we've seen in the last at least 8-9 months, we'll have to see now fundamentals catch over valuations, not the other way, as we are used to.
Yeah.
But if you see, many buckets are doing very well. So you don't find, mouth-watering opportunities. But if you look hard and deep, there are opportunities to hunt in. And for us, so we look at it in 3 buckets. One is value, which is cheap companies. The second is undiscounted change. And the third is long-term compounders. So, value is companies that are conventionally cheap, 40, 50, 60 cents to the dollar. PSU banks 3 years back. Many of the PSUs, trading at, all these defense guys were single-digit earnings. Those don't exist right now, or whatever exists is where there is a problem. And the danger for people like us at a time like this is, because we are value conscious, we are not value investors, we'll end up compromising on quality and go into lower tier businesses for, the valuations.
Sure.
And that's something that we are constantly guarding against. So the value bucket is actually quite, unavailable right now. The second bucket is perception variance. So either you see a bad result, a good business going through a troubled time, and the markets don't give it its due for a longer term basis. And that's a bucket we love to hunt in. If we've done our homework, we are ready with what we think is the limits of buying and selling, then we obviously act on those decisions where we think that we have a differentiated view against the market. And that comes with, being prepared when you have a bad result or a CEO changes or, any of these one-off things. But the second bucket where we had great success and we like to hunt is transition or undiscounted change. So one is, the constant change in India of, small going to medium or medium going to large. The other bucket is, like B2B to B2C. So one of the names we own was an institutional business selling a consumer product, and they've launched their brand in India last 3-4 years. It's like a 200 crore brand going to 500 crores in the next 3-4 years. Investments being made. And transitioning into other consumer categories like mini QSR and some of those ancillary areas. And that's a bucket where there are a lot of interesting opportunities, not just the one that I'm talking about. And interestingly, if you look at the consumer space as a sector,
sure,
the large names are reasonably priced compared to their historic numbers. But right now, the trade-off is between cash flows and growth. And the markets believe that some of these may suffer from growth. So there is actually a revolution in that space, right? I mean, look at your own ordering, for example. How many times have you ordered a pizza or a burger or something from a big box retailer, right? Because you trust the quality of the smaller guys. It's artisanal. It's not just templated product that they are giving you.
So effectively, pan-India large players need not necessarily be the thing. People are finding opportunities in niche, both for quality as well as for business.
That's right.
Okay.
And with the whole tech thing coming in now, whether you look at, so for example, I mean, we don't own Mamaearth or we don't have any interest, but this is a company formed in 2017, 12,000 crore market cap, 1,500 crores revenue last year, probably 2,000 crores this year, I don't know the number. But I'm saying that, something like this created in 5-6 years, it's come from nowhere, and it's a reasonably large business, and we'll see many more of these, whether it's Sugar or Swiggy or many of these unlisted companies coming into the market and challenging the current incumbent. So there are two ways of seeing it. One is from a consumer angle and the other is from an investor angle.
Okay, sorry, but before I go headlong into consumers, just trying to understand the basic portfolio construct, Mehul, to your mind, is that despite the fact that small caps might be expensive, that is where growth opportunities are coming, and therefore you are inclined to bet on small caps. Would that be a fair assessment?
So our approach is that, I mean, we are agnostic to the capitalization of the company.
But naturally?
But naturally we veer towards those areas because that's where the change or the transition that we are seeking is very high.
Got it.
And so one is this B2B. The other is, for example, commodity to value add. So 5 years, 10 years back, a lot of Indian companies were, N-9, N-10 steps away from the final product, especially take chemicals, for example, or auto ancillaries. Or, like Auto Anks would only do forging but not machining. Today, a lot of these guys have invested in high-end equipment. They are actually, selling the final product or as close to the final product as possible. So you are 2 steps or 3 steps away from the final product, and you are at global scale.
Sure.
So you are no longer a price taker by some guy in China. You are also a price setter yourself, and combine that with better margins. It's a very potent combination. The other bucket, for example, that we like is, import substitution. And we own a medical consumable business, for example. And, these are companies where multinationals were large, very large import component. And, at the end of the day, India has strengths in these areas with this whole wave of manufacturing, make in India, and incentives. Not only are these guys now strong in India, but they're exporting to Europe. I mean, India-branded products in Europe and, trying to make headway in the US. So there are many of these opportunities that, may not be mainstream. And that's why our strength is to make idiosyncratic investments. We are not necessarily looking at whatever is just mainstream, but if you go out of that mainstream and find these opportunities. So if you look at our portfolio, we are sector agnostic. I mean, if I ran a large fund like in the past, there has to be some index alignment and stuff like that.
Now you're not bothered with that.
It's just portfolio construct is just an outcome of what we like.
Got it.
And we don't want to have very homogeneous portfolio, right?
Sure.
So even in, for example, financials or consumers or engineering, capital goods or power equipment, for example, where we have reasonable interests, we are looking to invest in businesses that give different angles to the portfolio.
Okay, so I'm going to talk about each of these pockets, but still trying to just narrow down that point. So therefore, by virtue of the fact that you are bottom up and the portfolio construct is an outcome of what you like, is the portfolio largely skewed towards the non-mega cap, non-large cap part?
Yeah, sure.
It is.
Unless the mega caps are going through some sort of transition or change or market
is anything going through that right now? No.
Yeah,
within your portfolio.
I mean, one large media business was large, became mid, now is again became
But
large.
is it a
and
part of your portfolio?
No, I'm just saying that, there are some of those names where even like, we don't own like a lot of commodities, but a large steel company, for example, can potentially fit in that bucket. We don't own it.
Got it.
But, those are much more complicated to understand, which is why I'm just giving you examples of mega names that potentially can fit a bucket, but we've not hunted there yet.
Yeah, so no, but by my limited point, I was trying to understand that OysterRock as a portfolio manager currently is biased towards the mid cap and the small cap end.
Yes.
Not too many large cap
Yes,
investments.
that's correct. That's a fair statement to make. Yeah.
Okay, that's part one. Now, part two, within this, and I know it's an outcome of what you own, but is there, by virtue of that, a larger allocation that you may have made towards a particular theme? It could be manufacturing, it could be financials, it could be internet, what have you.
Sure. So yeah, we have, like engineering, if you bucket the whole thing into one, which is engineering, capital goods, power equipment, yeah, we have interests in that area. And that is because, it's gone through 10 years of pain. If you see balance sheets, companies that were, 300, 500 crores of debt have actually repaid, now net cash positive. Obviously, the whole infrastructure investment, which has happened in the last 3-4 years by the government, is an important source for that growth that we are seeing. But there are some interesting developments that are happening. So if you go to Europe, there are so many small companies in the range of 10 to 50 million run by, people who are 70, 75 years old, no successors readily available. And, a lot of our investments are buying these companies. So it's not an insanely large risk they are taking, but they are building a product business or getting a product capability that didn't exist earlier.
Got it.
And, that actually has become a very good engine for growth. So we are not necessarily looking at pure, of course, India is doing well and will continue to do well as, so far it's been government, and now private sector as it kicks in with, capacity utilizations wherever they are, 77, whatever number, we assume. It's now at a place where at some point that kicks in. So India is one leg, but
you're playing India, but you're playing global.
Yeah, you are getting and this is not pure global because, you are not leveraging up insanely, and you're buying very niche product businesses, whether it's valves, pumps, motors. Pick an area, and there are interesting names that I can throw out, which I can't talk on TV, but.
Okay, great. Mehul, let's talk about specific pockets. Now, you seem to suggest that engineering and construction, amongst others, is an area that you are definitely focused on by virtue of the portfolio companies that you may have. Is there value here, or would growth take care of higher valuations?
So growth always takes care of higher valuations and all the mistakes we make as investors, right? And if the growth doesn't come, then the mistake is amplified. And if the growth comes, then our mistakes get hidden. And, that's an honest confession. So we do believe that in many of these names, growth is an important criteria. So most of these are trading between, let's say, 20 to 30, early 30s. So they are not insanely expensive, but they are not cheap either. And, in these businesses, because of the cyclical nature of the underlying profits, typically you're not going to find them very cheap in up cycles as we are seeing now. And the interesting part is that, one is the capex that we've seen by the government, we see on the private, but a lot of these guys are going out now, and they have already built or are building capabilities to sell to the world, which didn't exist. So whether it is, like I said, in pumps, motors, gears, whichever product you take, power equipment, whether it's, turbines, etc. So there is an opportunity, one, to win market share overseas. And, we know about US, Europe growth, etc. And I don't want to delve a lot on that. But, so buying, they are actually acquiring some of these smaller businesses, not putting their balance sheets at risk by doing so. And of course, the balance sheets are much more healthier than they were even 5 years back. And in addition, all these guys have, actually cut muscle dramatically in the decade that went by from 2010 to 2020 because they're all suffering very badly.
So you're saying they're deleveraged quite
Yeah, they all
significantly.
deleveraged, no, and even from a cost standpoint, I think a lot of these guys are absolute bare bone right now. So they've got to, now you'll see them adding costs, building muscle to actually fulfill some of the growth that we are seeing.
Got it.
So right now, profits are also looking very good because they are bare bone structures in many instances. So we'll see, profits growing at a healthy clip, and not so many of them, for example, were in projects, and now they've transitioned to only selling products, which is their core. They meandered in the late,
Sure.
2010 and 2011 into doing stuff that they were not good at because they foresaw growth, which never happened, or in fact went into losses in many instances.
But they have, I think, course corrected.
Yeah, so now they've actually corrected their businesses.
Sure, of course.
And those are very interesting opportunities to hunt in. So they are not necessarily, very cheap, but growth hopefully takes care of that.
Okay.
And obviously we'll make some mistakes as we go along in some of those
course.
names. But on aggregate, if we are fine, then we'll be okay.
Okay. The other aspect, I heard you mention power equipment.
Yeah.
Now, are you playing power as a theme through power equipment alone, or are you also doing other things? Because one, there are these suppliers, power equipment players.
Yep.
Two, there are power financiers, and three, there are the pure play generators. What do you like the most and why?
So we like the equipment guys the most because they suit our investment approach, where there is a change, either capacities have doubled or capacities are increasing by X%, or they are building capabilities in ancillary areas that didn't exist in the past.
For example?
By acquiring something in and around that space. So a guy who makes turbines will do something else, or a guy who makes generators, or basically they are going into ancillary areas and not creating a large risk on the business like they did in the past, most importantly. So that's one bucket. We also like the power financiers, and some of them are interesting. Many PSU banks also do it.
But there are only a couple of listed names.
Yeah.
First, right?
So we do like a couple of those names, and I think most of them will do well, or even the banks that have exposure to that area will do well. And as we go into summer and the anticipated power situation will benefit more investments in that area. So whether it's in new energy or in old energy, we are going to see a lot of that coming in.
Okay.
And we don't necessarily like the annuity type businesses, though they've done very well in the recent past. This is a cyclical thing, and some parts will do well, some parts won't do well. We'll own some, and by and large, when the underlying growth engine is at work, most people will benefit out of this.
Sure.
So we like to play it through the shovel makers as opposed to the gold diggers. So we are more focused on that zone.
Okay. Have you by any chance played real estate in this theme, and are you playing real estate also through instead of developers through the ancillaries, shovel makers as opposed to the gold diggers again?
Yeah, so actually, in that space, the shovel makers haven't done very well only in the immediate past, like the last 4-5 months, they've done okay, but they've had a rough time preceding that time. And our belief is that, they will obviously come in when, the keys are handed over to buyers. And the market obviously was concerned around that. But having said that, real estate is an important source of growth for the country and the economy.
Yeah.
And a lot of growth that we are seeing is also an outcome of that. The real estate cycle having done well in the last 2.5 years or so.
You think it will continue?
Hard to say, I don't know. But right now, at least the higher end of the market seems like there is some slowing, and we've got to be a little cautious on that front. But we don't know that business very well if you go like outside the areas we know, and it's a very local market, so you've got to get that, and unless you get that, making a general statement is very risky.
Fair call. Okay, we have a couple of minutes left.
Sure.
I would love to understand, have you played any of the newer themes that have come up? So in the last 3-4 years, if you look at it, defense came back into vogue, railways came back into vogue, EMS as a sector gotten created, So there are these 3, 4, and not even talking about green hydrogen, green
Sure,
energy, etc.
sure.
Have you played any of the newer themes?
Sure. So I don't think defense is a newer theme
Yeah,
or
but
railways, but they are the ones which have done
Reincarnated, if you
well.
will, yeah.
So yeah, we did. I mean, we do have investments in a couple of these areas, but we are also worried. So, in both defense and railways, we've seen, in the past that orders which, people thought would get executed in 3 years or 4 years or 5 years actually took 10 years, 12 years. And, commercializing many of these products, and by commercializing, I mean even a missile, for example, to actually make 60, 70, 80 missiles of something took much longer than it really did.
Sure.
So, we come with a hangover of that. And if this time they actually execute in the time frames that we are hearing about in terms of the execution cycles, then I think they are not necessarily as expensive as they appear to be. But you never know these things. I mean, growth has its own way of disappearing, right? So we don't want to overpay for growth at most points in time. And in the defense and the railway areas.
Currently, you are overpaying for growth?
So, yeah, you're paying for growth. And, of course, you can see that, right? They were all trading at, single-digit valuations or very low 2-digit valuations. And today they are all significantly higher.
So are you overpaying? Sorry, we're out of time, but
Sure.
are you overpaying for growth currently in defense, or are you paying
It's
fair
hard
value?
to say. If the growth comes, then you're not overpaying. But right now, based on our experiences of what's happened in the last 15 years, we would be skeptical. But I'm sure that people will do well. It's just that it's very hard to figure out which projects out of those very large ones
Sure.
will actually see the light of the day in the time that they are talking about.
Time they're talking about. Yeah, sure. Execution risks certainly need to be kept into
Yeah.
account. Mehul, thanks so much for joining in today and giving us your thoughts. Really appreciate your time
Sure.
this afternoon.
Sure. Thanks.
And
Thanks for having me.
out of time completely on this show of the Portfolio Manager viewers. Thanks for tuning in.